Hello everyone, welcome to EF Talk Show. Today we have with us Mr. Deepak Jain, President and Head Sales, Edelweiss Asset Management Limited. Welcome to the show, sir.
Thank you so much, Saurav, for having me here. Really looking forward to our interaction.
Yes, sir. So, sir is going to help us with an introduction to the newly launched product, which is specialized investment funds. I'll start off with a very basic question, sir. So, what is the basic difference between a SIF and a mutual fund?
Excellent. So it's a good beginning. Before I get into the comparison between a mutual fund and an SIF, let's look at the history of publicly available platforms for people to invest and the choices that they have. There are three of them. One is a mutual fund, of course, and the other two are alternate investment funds and PMS. The
Right.
PMS came into being in 1993, AIF regulations came in 2012, and mutual fund as a platform in terms of regulations, etc., came in 1996. And we all know that though all three have grown, but mutual funds acceptance has really far exceeded the acceptance of the other two. Put together in AIF and PMS, you have close to 10 lakh crores of assets. In mutual fund alone, the number is about to touch 80 lakh crore, and it's growing fast. But there has to be some, great benefits that mutual fund also enjoys, and we need to really understand what SIF actually is trying to do by being launched by the regulator and now by many mutual fund or asset management companies. Now, if you look at the pros and cons of these three vehicles, starting with mutual fund, it's a transparent product, easy, convenient, uh, wide reach. You can invest with as low little as 100 rupees or 100 crores, doesn't matter. Variety of choices, etc. But AIFs also score over mutual fund in terms of leverage capabilities, naked shorting abilities, doing things which are a little more nuanced. I wouldn't say risky, but things which are a little more differentiated are allowed in AIFs. On the PMS side, you know that you own the stock directly in your demat account. The product can be customized to your needs, so on and so forth. What SIF actually tries to bring is the best of all three, and technically it is a mutual fund. And I'll explain the both points that I'm trying to make. So, what exactly is trying to get the best of, let's say, PMS and AIF? So, from a PMS perspective, there are products in SIFs which can be launched which are similar to PMS in terms of, let's say, taking risk beyond small cap, which many PMSs do, taking concentrated, stock positions, and also having the ability of shorting if you don't have a positive view. Similarly, on the AIF side, the fact that AIFs are allowed to go naked short, which is now also available in SIF. But the one big negative, in my opinion, as far as SIFs, AIFs, and PMSs are concerned, is the tax part. The tax is every year, and in case of PMS, it is tax on every transaction now. So if you have purchased or sold any stock or security, either short or long, short term or long term, there is an incidence of taxation. And at the AIF level, in most cases, the tax is payable at the fund level, and irrespective of whether you are a low tax paying entity or a high tax paying entity, you actually end up paying the highest possible tax. Now let's look at SIF. What SIF is all about? In short, there are three things which are possible in SIF, which are currently not possible in mutual funds. One, a there is a 25% naked short which is allowed, and I'll elaborate on that maybe during our discussion further.
Yes.
B, in terms of fixed income securities, you're allowed almost twice the exposure that is allowed in mutual funds. So you can actually create a focused portfolio of fixed income or hybrid, as the case may be. And third, the redemption window could be very, very differentiated from mutual fund. So from mutual fund, everything is 3 p.m. cutoff and T plus one or two, as the case may be. Here you can have weekly redemption or a monthly redemption, and so on and so forth. So that's uh, in nutshell three things which are different. In terms of similarity, everything else is similar. taxation is similar. um, your statement processing, the infrastructure that the SIF is using is AMC. In fact, in order to launch an SIF product, you must have a mutual fund license. So you cannot just launch SIF just because you are any other asset management entity. You have to have a mutual fund license. So there are the similarities and differences. We can take more questions on the same subject.
Sure. So, sir, moving ahead, I would want to understand which is the best investor profile. When I say best, it can be an investor profile wherein who should be investing in SIFs and who should not be. So, if you could elaborate on that bit, sir.
So, from an investment profile perspective, I think first of all, since you're making a 10 lakh rupee investment, it's not necessarily a very retail first time investor. It has to be a HNI, MNI, whatever you call it. Someone with a net worth of, I would say, 2-3 crores or more, and not somebody who's only investing first time or second time with total investable surplus of 25-50 lakh. For that, in my opinion, it could be a more riskier proposition, only in terms of concentration, not necessarily in terms of market risk. That's point number one.
Okay.
Number two, I would also encourage people who have had their journey of mutual fund to come into AIF and not necessarily make this as their first port of call. And third, people who either want risk adjusted return in a differentiated manner, or probably want to make investment in a higher risk product, can actually look at SIFs in general. So SIFs can be used to increase your risk or to decrease your risk depending upon the product that you choose.
Okay. So, when you say depending on the products, could you please help us understand the different categories within the SIF space?
Sure. So SIS are also will be allowed three broad categories of funds. Now we all know that in mutual funds you can launch equity funds, fixed income funds, and hybrid funds.
Yes.
Here also the three categories have been allowed, which is equity, fixed income, and hybrid. In equity you can launch three products as of now. In fixed income you can launch two products, and in hybrid also you can launch two products. We can take all these category one by one and move forward. Shall I do that?
Yes, sir. Please.
Okay. So if you look at the equity space, one thing that is common across every product is 25% ability to short.
Yes.
Now the first product that is allowed is equity long short. From a long perspective, you can actually go anywhere. It's like an all cap stroke flexi cap kind of a portfolio where there is no restriction in terms of how much you should invest in large cap, mid cap, small cap, micro cap. Um, Other than single stock exposure limit and sectoral limits, which mutual funds also have, there is no other restriction that equity long short would have. Now, in terms of strategy, you can either be very aggressive and launch a 75% long, 25% short strategy, or you can have 77 or 80% arbitrage and 20-25% naked short. So it depends upon your view, what view you carry. If you have a positive view, you can have a more riskier or more long term bet. And if you are not so positive and if you are negative on the market, that can also be expressed by a combination of strategy. Now, the second category. The second category, in my mind, is very, very interesting, especially for people who like to invest in mid, small, micro through PMS or any other route. For them, this is a God-given, God-sent opportunity in terms of efficiency and tax, post-tax returns. A This category will invest only in companies which are mid, small, micro, and nothing in large cap. It's called X Top 100. Okay, so X Top 100, you can invest anywhere. Minimum investment required in the portfolio is 65% equity, and you're also allowed to short up to 25%, as I said. But to my mind, this can be run as a very high conviction, small, micro, medium portfolio, a mid cap portfolio of 30, 40, 50 stocks, depending upon various managers. And long term alpha can be generated via this product. The third one is sector rotation fund, where a manager will be allowed exposure of maximum four sectors. So it's like a thematic fund in that sense, but not necessarily a common theme. You can actually invest in four sectors or two or three, but maximum is four. One sector exposure can is topped at 75%. There is one more nuance here, which is if you are going long on a sector or any stock in that sector, you cannot go short on any other stock in that sector. So you can, in a sector, you can either have a long position or you can have a short position. Both long and short put together, you can only invest in four sectors.
So you
So
cannot have a contrarian view within the same sector itself.
exactly, so you cannot buy Bajaj Auto long and short Hero Honda, Hero
Got it.
Motors.
Got it, sir.
That cannot be done. While it can be done in the first two instances, in the sector rotation fund, it cannot be done. Now let's move to uh, the third category of hybrid, which in my view is very interesting. Um, so starting with hybrid long short. So hybrid long short, the regulatory requirement is minimum 25% in equity and minimum 25% in fixed income. Now, if you keep more than 65% fixed income in any portfolio, from a tax point of view, it becomes very inefficient because everything gets taxed at maximum marginal rate. So most people will have not more than 60% fixed income, and the balance could be either equity or combination of uh, long short strategies. For instance, I know of three products which are doing three different things, which has already been launched. So Edelweiss, SIF is called Altiva. So we have launched a product called Altiva Hybrid Long Short, where what we are trying to do is basically try to deliver 10 to 12% gross returns to investor and post tax, post fees of 8%, but without taking too much of directional equity exposure. We are taking some fixed income up to 60%. We are taking some arbitrage and covered call, and we are taking some special situation trade like IPO, open offer, merger, buyback, not a traditional equity call. It's so an IPO trade is a week's call. Basically, you invest during the anchor and you want to make your listing day gains and disappear. Similarly, a merger or a buyback is only applicable if that story plays out and your shares are either tendered or you receive those in your account. So these are the strategies which can be played. Some other person can actually make it very aggressive. Can have a 65-75% long position and then also have combination of long short, which some other player is trying to do. So, but it's a very interesting category. If you remember in AIF, there used to be products called either absolute return funds or enhanced equity funds. But from a tax efficiency point of view, they used to really get 40% tax. Here, because of the mutual fund structure, and if you don't hold more than 65% fixed income after 2 years, the taxation is only 12.5%, which is excellent. So, for example, even if you get 9% return in your, unless you sell it, there is no tax. If you sell after 2 years, there also the tax is 12.5%. So it's very, very effective and efficient way of getting people to invest in a moderate risk, moderate to high return product. Another one is active asset allocator. Now this is very, very interesting. It's a multi-asset fund plus plus. So in multi-asset, we know that there is equity, there is fixed income, and there is gold or silver. There are three asset classes. Some people also buy some InvIT, some REIT. Some people also invest in global equities, but most of them restrict themselves to these three. Okay. Now in SIFA, there is no minimum requirement of 10% in each asset class. So if your view on gold silver is bearish, you can have zero also. So that's a differentiated position. Similarly, if your equity exposure, you don't want to have any equity exposure, you need not have any equity exposure. But today REITs are classified as equity. So you can
Yes.
actually create a real asset portfolio of 20-25% REIT, 10% in weight, some bit of arbitrage, some fixed income. So it is a truly actively managed multi-asset category, which to my mind in next 2 to 3 years would become a very sought after category by both retail and HNI clients.
Thank you. Thank you for this great explanation, sir. There would be a follow-up question. So when you said if someone's bearish on gold or say silver for that matter, can we also go a 25% short via derivatives on the
Yes, yes,
commodities
will
per
be
se?
allowed. Yeah,
Okay.
exactly. So you will
Okay.
be allowed. So for example, we run a product called multi-asset allocation fund where we don't take directional equity exposure, but we do arbitrage of silver.
Okay.
So we buy silver in physical and then we sell future of silver. We have made 9-10% returns just by silver arbitrage, which is more than equity arbitrage.
Okay.
So yes, it will be allowed.
Okay. Got it, sir. Thank you so much, sir. I would move on to the next question then. So, when the basic notion of the public would be that since there's a 25% derivative exposure allowed within each fund, so the return expectation tends to be high double digit. Could you please give us a brief on if this expectation is correct, or would you want to help us with an understanding of the risk to reward ratio within each category?
What I can actually say that either your risk has to get substantially reduced. So for example, in hybrid long short, uh, we believe that the return could be in the range of equity savings plus BAF, put to somewhere there, but the risk could be half. So that's also a big thing, right? So for example, an equity savings standard deviation could be an 8. On the other hand, HLS hybrid long short standard deviation could be 3, and the returns are not compromised. So that is also from a risk adjusted perspective, you are delivering higher superior experience to customers. And on an equity strategy, it is not unfair to believe that from a relative basis of a similar style product, I should be getting 2-3% more. So, for instance, if a flexi cap fund is, let's say, I'm just talking numbers here and with all the disclaimers that are required to be put, if
Yes.
somebody is expecting 12% in a normal flexi cap, the ideal scenario would be to expect 15% here. So, yeah, so that's obviously the case, or the risk has to get substantially reduced that the 12% becomes very, very stable. Either one of those two objectives have to be, either your risk gets reduced substantially or your returns gets increased substantially. So the net alpha increases for the customer. So that should be the objective.
Got it. That was a great explainer, sir. I would now want to understand if so, like you mentioned, that the hybrid long short fund would have a net of expense post tax return of around 8 or 9%. That is what we generally see from a equity savings fund as well. So, why would we want to take monies out, or say not invest in equity savings and put it in this basket?
So great question. I would like to believe that, A, first of all, these returns are not guaranteed, neither of equity
Yes.
savings nor of hybrid long short. It is just our assumption based on a certain holding period.
Yes.
Okay. Given that as a very important disclaimer, if you look at equity savings as a category, people don't invest there for growth. They invest there for growth, so income plus growth. I would like to believe the primary reason is stability, income, and some growth if it can come, right? So the volatility will be very discouraging for many investors. So if you look at average standard deviation of an equity savings basket is close to 8%. Equity funds are 15-17%. The equity savings itself is 8%. So for an 8-9%, you can actually have an 8% plus minus experience of over a given period of time. The moment it goes below 3 or 4, it gives a much consistent and regular experience for an investor. So if an investor wants to do an SWP, for example, a 6% SWP with some money left behind for growth, this could actually be a better proposition for those kind of investors than a simple equity savings, because most equity savings fund have directional exposure of anywhere between 15 to 50%. Here, at least in our product, the directional exposure is only limited to the special situation trades. Other than that, there is no directional exposure.
Okay.
In fact, in
That
our experience, we have seen in the back tested strategy that on a 2 year basis, the minimum return have been 7%. So
that's
minimum is 7. On a whether on and I'm not trying to discourage people from investing in equity savings. We also run a very well managed equity savings, but it serves a different purpose in terms of reducing volatility, giving customer better experience. See, we did not have those tools that are now available in SIF. For example, covered call strategies. Now, you can argue why can't you do similar strategies in, we do, but you can do only up to a limited point. So of whatever you hold in as an equity portfolio, only up to 30% of that can be done as covered call. Here I can do, there is no limit. I don't necessarily have to have a long position, which is, complete or, beyond a certain period for me to create a covered call scenario. So that's really, the nature of the product, which allows us opportunities to give better experience to clients.
Okay. So, sir, I have just one last question for you. If anyone comes into this product category, what should be the minimum investment horizon that he or she should be looking at?
2 year plus, simply because of taxation and also the way strategies are run. I would say 2 year plus. And anyone having money less than 1 year, I think arbitrage or any other fixed income option could be a better play. uh, 2 year plus is a decent investment horizon.
Thank you so very much for giving us a brief introduction on the new product category, which is a specialized investment fund, sir.
Thank you
For
for
our,
having me here. Really enjoyed the session.
yes, sir. For our viewers, if you've liked the video, please like, share, and subscribe to our channel.